Imagine two people starting their financial lives at the exact same age. They earn similar incomes, they save similar amounts. They both want security, freedom, and a comfortable future. But decades later, one retires financially relaxed, while the other struggles, despite working just as hard. The difference between them is not intelligence, it is not luck, and it is not even how much they earned. The difference is psychological. Today we are going to explore one of the most misunderstood ideas in investing and decision-making. Why human behavior, not market performance, is often the real driver of long-term success. And to understand this, we need to look at how people actually behave when uncertainty enters the picture. Psychologists Daniel Kahneman and Amos Tversky discovered something profound about human decision-making. People experience losses roughly twice as strongly as equivalent gains. Losing $100 hurts far more than gaining $100 feels good. This bias, known as loss aversion, evolved for survival. Avoiding danger mattered more than seeking rewards. But in modern financial systems, this ancient survival instinct creates a paradox. The very instinct designed to protect us can quietly prevent long-term growth. When markets fall, our brains interpret temporary declines as threats rather than normal fluctuations. And once fear activates, rational thinking becomes secondary. Let's imagine an ordinary saver. This person works consistently, saves responsibly, and wants to invest wisely. But there is one problem. They are deeply uncomfortable with uncertainty. Every time markets rise, they worry they are already too late. Every time markets fall, they fear things will get worse. So they wait. They wait for clarity. They wait for safety. They wait for the right moment. Eventually, confidence builds just enough to act, and almost immediately afterward, markets decline. This happens again years later, and again. From a timing perspective, their decisions appear almost perfectly unlucky. Yet something unexpected happens over time. Despite poor entry points, their investments slowly grow. Not quickly, not smoothly, but steadily. Why? Because one behavior remains constant. They stay invested. Markets are often described as unpredictable. And in the short term, they are. Prices react to news, emotions, politics, and global events. But over long periods, another force becomes dominant: compounding. Compounding does not rely on perfect decisions. It relies on uninterrupted time. Each year's growth builds upon previous growth, creating momentum that gradually outweighs early mistakes. This is difficult for humans to intuitively understand because our brains think linearly, while compounding works exponentially. Small differences sustained over decades create enormous divergence. Instead of viewing investing as a technical skill, it helps to think of it as a psychological pattern. Most people fall into one of four behavioral categories. The predictor. This person believes success comes from entering at the perfect moment. They study headlines, forecasts, and charts, trying to anticipate turning points. The consistent participant. This individual invests regularly regardless of market conditions. They rely on routine rather than prediction. The avoider. This person prioritizes safety above all else. They remain mostly in cash, waiting for certainty that never fully arrives. The imperfect holder. This individual makes imperfect timing decisions, but remains invested once committed. Interestingly, long-term simulations repeatedly show that the largest difference in outcomes does not occur between perfect and imperfect investors. The largest difference occurs between participation and avoidance. Being slightly wrong while participating often beats being perfectly cautious while absent. Market timing sounds rational. Buy when prices are low. Sell before declines. Simple in theory. But timing requires two correct decisions: when to leave, when to return. The second decision is psychologically harder. Major recoveries often begin when economic news still feels negative. Emotionally, it feels unsafe to invest during uncertainty. By the time confidence returns, markets have frequently already risen significantly. This creates a behavioral trap. People exit during fear and re-enter during comfort, unintentionally reversing the ideal strategy. Long-term market performance is not evenly distributed across time. Research examining decades of daily returns shows that a surprisingly small number of trading days account for a large portion of total gains. Missing only a handful of strong recovery days can dramatically reduce long-term results. The challenge is that these strong days often occur close to major declines. Periods of fear and opportunity tend to arrive together. Avoiding volatility may also mean avoiding recovery. Most financial mistakes are not caused by lack of knowledge. They are caused by emotional interference. Fear encourages selling after losses. Relief delays reinvestment. Confidence appears only after prices rise. Successful long-term investors often reduce emotional decision-making by creating systems. Automation replaces judgment. Consistency replaces prediction. Instead of deciding repeatedly, they decide once and allow routines to operate. Patience is often misunderstood as inactivity. In reality, patience is active restraint. It means allowing uncertainty to exist without reacting impulsively. In behavioral psychology, this relates to delayed gratification, the ability to prioritize long-term outcomes over immediate emotional relief. Financial markets reward this trait because growth unfolds gradually, while fear appears suddenly. The challenge is emotional endurance, not analytical brilliance. There is an important nuance. Mathematical optimization is not always psychological optimization. A strategy that looks perfect on paper may fail if it causes anxiety strong enough to trigger panic decisions. Sometimes a slightly less efficient strategy that someone can follow consistently produces better real-world outcomes. Behavioral sustainability matters more than theoretical perfection. Many people define risk as short-term loss, but from a long-term perspective, another form of risk exists: missed participation. Money that never enters productive systems cannot compound. Avoiding volatility may feel safe emotionally while quietly reducing future possibilities. True risk is often invisible in the present moment. Instead of asking, "Is now the perfect time?" a more useful question is, "How can I design decisions that I will still follow during uncertainty?" This shifts focus from prediction to behavior, from control to preparation, from short-term emotion to long-term structure. Markets will always feel uncertain while they are happening. There will always be headlines predicting crashes and rallies, but history suggests something consistent. Success rarely belongs to those who predict perfectly. It often belongs to those who remain present long enough for growth to occur. The goal is not perfection. The goal is participation sustained by discipline. Because in the long run, the greatest advantage is not timing, it is time itself.